Good morning. Welcome to the Orlando Real Estate Buzz. I'm Brenden Rendo with the Homes in Orlando team. And of course, we're joined by our good friend, Joseph Dionne of Appli Home Loans. Heck of a morning already this morning, Joe.
Yeah, the CPI, they come out right at 8:30.
Yep, on the button.
Were they not good?
No.
Not at all.
Came out CPI 8.2%. I believe they had hoped it would drop to 8 or maybe 7.9. See some kind of reduction in that inflation rate.
Yep.
But we didn't. And then when looking inside the numbers, the core, which takes out food and basically your energy costs, was the highest in 41 years.
Yeah.
So whatever the Fed is trying to do, it's not working. It's just not working.
Just not at all. And it's really, really tough because you look at a lot of this data and it's, rent costs continue to go up. But here's the hard part. It's like, rent costs are going up, but then you also see rents are going down. And then you see builder costs are going down, but then they're also going up. And I'm like, man, I feel like nobody knows really what's going on. And that creates that little bit of extra confusion, which just impacts all of this.
Yeah. I mean, there's just so many factors that are just, it's like getting hit by Mike Tyson, 8 times, boom, boom, boom. And you don't see any of them coming. None of them. You've got the Bank of England, who is just in a royal mess. That's affecting our treasuries as well. They went out and said, oh, we're going to buy, so many bonds to help stabilize the market. They were $5 billion a day, then $10 billion a day. And they didn't do it, really. They bought like $3 billion total over 4 or 5 days.
Yeah.
Everyone looked at it and then freaked out again. So that's putting upward pressure. Our dollar, like we talked about last week, our dollar is higher than it's ever been. I think it's like 1.14 on the Dixie. Mm-hmm. It's never been that high. I think the previous high was like 1.06.
Yeah.
Somewhere in that ballpark. And then you got the UN telling the Fed to stop raising rates because you're going to cause a global recession.
Yep.
And
that's just going to make things worse.
Yeah. I mean, you sit there and and then I watched a little interview clip with Jerome Powell yesterday. Mm-hmm. And they're asking him, about the money supply. He goes, oh yeah, we created it digitally. We just created it digitally. And then, oh yeah, because we're the Fed, we can print money. And we printed money and we put it into the Federal Reserve. And oh yeah, we kind of knew this was going to happen. And you just want to take the guy and wring his neck.
Here's the thing that I always do. When the Fed chair is a household name, you know shit's going to be bad. Excuse my language. You just do.
It's true.
When everybody knows who the federal chair is, it's bad.
Because you should know who this guy is.
It's kind of like when you talk about a football game after the fact, and all you can do is talk about the refs. It's a bad game.
It's a bad game.
And that's where we're at right now. We have so much. I have mentioned Powell's name more in my life than I care to in my life in the last 3 months. Year it's like, it's just, there's bad days and they happen once in a blue moon, but it's like at least twice a month we have bad days. Today is starting, down 110 basis on MBS just so far this morning. And markets have been open for an hour.
Jeez.
You're talking literally, if right now, most investors are probably going to hold off with releasing rates because of the volatility. So instead of getting rates released around 10 or 10:30, we may look at 11:30. We'll probably, I can be honest, we'll probably have a number of investors that will suspend pricing all day if we see this volatility. They'll just say, we're not going to allow a lock because we want to see what happens. But I would say 120 basis, if we're like when people start opening, if we're sitting where we are right now, easily 0.25% worse in rates today from yesterday.
So we're talking, we could be 7.5 today.
Yeah. Yeah, real easy. Like we saw that slight improvement, yesterday. Bonds. Now, here's the key. Like, there were some big economic reports yesterday, but market opened really negative. By the end of the day, they finished in a little bit of positive territory. Rate average actually went down. Mortgage News Daily says the national 30-year average right now is around a 7.05 unconventional. That A-tier, A-plus client. The hard part when you see stuff like that and it becomes bigger and bigger is what people don't realize, and we've talked to a lot of clients, is, well, when you see that A-tiered rate, like if you're a B-tiered client or a C-tiered client, you're not touching that rate.
You're not touching it, no.
And a year ago, if you were A-tiered to B-tiered might be 0.25% different in rate. Now that difference might be 0.5% in rate.
Yeah.
That's the key.
The spread between the 10 and the bond and the mortgage rates is increased. You've got a lot of investors who are increasing that spread to cover their butts.
Yeah, they have to.
Yeah, because rates going up makes them riskier loans, number one. And then you've got everyone hoping, praying that, they'll get this under control and they'll be able to bring the rates back down. And if you bring the rates back down, people are thinking, oh, in a year I can refinance and save myself some money. Yeah. So the investors are thinking the same thing. And they're like, well, I've got to increase my yield because there's a good chance, I'd probably say 80% chance that these people are going to refi after a year.
On a standard,
if rates come down
on a standard loan, like a loan originated, an investor isn't profitable until like a servicer investor type, a servicing type scenario, typically isn't profitable until 15 to 18. So if they got to be a year and a half to break even before they see any threat of profit, and the overwhelming hierarchy concern is rates are going to get a lot, are going to improve quickly at a certain point, and all these loans are going to get refinanced potentially. They got to try to say what we normally would take as a 15 to 18 month note, realizing that we may only have 12 months with this note. So how do they get more profitable with that? And every investor is thinking this. How do we make sure we don't lose our butts? And we're seeing this play out in the mortgage industry. Like there are companies exiting the wholesale market, broker market, exiting retail to focus. Like everybody's starting to narrow what they're willing to do, because everybody, like a lot of businesses on the mortgage side are like, not just companies like myself. I mean, the people that we go to, the investors, the banks, the money, the guys that have all the money. They're saying, all right, what avenue am I willing to ride out through all this turmoil? And we see it constantly, like stalwarts. Like we saw when COVID happened, like companies that bailed out other companies because they were originating, they were cranking, they were doing whatever it takes. They're like, sorry, we can't do this again. Like we weathered the storm once, we made massive profits, but right now we're just hunkering down and trying to weather the storm because, and I've talked to some different companies, like P&Ls are in the negative for most places. Our company is in the positive, but that's because we're small. We're nimble. Like we're a boutique still. Like we're growing. We don't have high carry costs, but companies that are 50, 60, 100 people or 1,000 people, most of them in the mortgage space, their P&Ls are negative millions. Nobody's making money right now, quote unquote.
Yeah. So it's just, it's one of those, you get up, you watch, we keep our clients and people educated on what's going on in the market, and try and create the best scenario for them, overall, long haul. It's just, it's tougher some days than others. Quite honestly, it's tougher some days than others. Well, one other thing we wanted to cover today was in the news, and we've seen this a lot, is FHA has come out and they've said that they're going to include the one-time rental payments for the first-time home buyers. And you and I talked about this, and is it really something that's really working? Is it something that can really help? And you still have to do a verification of rent when you do a loan, correct?
Yeah, typically it's something that we still like almost on all, like, so the thing that a lot of people don't realize is this sounds like, wow, this is really cool. This is FHA really caring about the consumer. We actually I think we saw conventional Fannie and Freddie start saying the same thing.
Yep.
But it's a little bit of, in my mind, a little bit of a smoke and mirrors, because on FHA, on manual underwrites, we already look at this. So this is already something that can positively impact them and allow them to get a home and buy a home with FHA, even if their credit score is not where it needs to be, which is pretty much what this, what FHA's announcement is.
Yeah, I read the whole article, and I'm like, I don't, even from days when I was originating, doesn't seem any different than what they do currently. I think this is one of those where they're trying to put some positive news out there in the housing market.
Yeah.
Because we've got nothing but battered again. And you got to throw some, you got to have people, you can't totally crush the housing market. So you've got to give people that light at the end of the tunnel. Oh, maybe I can get a house. I'm paying $2,500 a month in rent. Oh, if they, my credit score is sitting at a 600. Maybe with this, I'll be able to qualify. For that loan. And that's, I think I agree with you there. It's one of those where they're trying to put out some information, trying to keep people, people who may not be looking in the market because they've got that credit that's not quite there, as give them a little bit of hope, see if they can generate some additional buyers into the market, which is something, quite honestly, we need right now. Because there's a lot. I mean, there's sellers, there's buyers sitting on the sideline. And the one thing I did take out of it was with Experian, the Experian Boost. And this is something that, it was the one thing I did get out of it, is that before you do go and talk to your lender and have them pull your credit, is Experian Boost program. You can go in there and actually put your rental information in there, and on average, it's giving a consumer about a 14-point boost in their credit score. And it's really not that hard. You've got to connect your bank, to Boost for whichever one you're paying your rent out of. Okay, they go in and they'll actually verify it, and then it will increase your score. It's actually it's a pretty simple process. The one thing I wish we would see is that it was across all three bureaus. Because that can make a real difference.
Yeah, Experian does a really good job with their Boost piece, because not only do they do the rental, but if you make you pay your credit, your phone bill, you pay your internet or your cable, you pay like your water utilities, they'll add those things. And Experian does it pretty easily, because you just add your bank account and it analyzes and sources to figure out what's valid or what's not. And that's a big piece that, hey, like if you can do that, it's going to help a lot of people in that sense. because maybe that person that's got a 610 gets an extra 15 points and goes to a 620. And, AUS automatic underwriting system is going to run more favorably for someone at a 620. They're going to get a better rate at a 6. And it might not be a better rate. It might just be, maybe that 7.25 that they were getting at a 610 costing $5,000. Maybe it costs $2,000 now. That's that's a big difference.
Yep. Which, I like it. I think it makes a lot of sense. Being able to add your phone every month, your electric bill every month, you got to pay them. You got to pay them consistently. So why shouldn't you get credit for it? And especially rent. That's
exactly.
The rents are as much or more than most mortgage payments these days.
Yeah.
So give me some credit for it. Let's boost their credit, and maybe we can help them get over the bump.
Exactly.
So let's hop into our numbers for the week, because I know we're on a tight schedule. This week we actually hopped back up to 479 sales. So you see, Orlando's still sitting in that 500 a week when we get into the graph.
Yeah.
And interesting enough, we actually took a pretty good bump in the median sales price, about 2.5% up.
Okay. Interesting.
Which is interesting, because everybody else across the country is going down. And then our condos, again, we jumped back up to where they were averaging before the storm, which is 156. And their median price is holding very consistent. Very consistent. And we were looking for some boring news. Here's our boring news. Is our original to final list price is sitting pretty consistent. On average, about $16,000 off. And we're sitting right at that 4 to 5% off of the original sales price. And that, again, has been consistent.
Yep.
For about the past month. So, we're sitting there, we're sitting consistent. Here's our median price. You see, this week we actually jumped up a little bit. Someone sold a nice size house.
Yeah, there you go.
And then
usually what happens.
Yeah. And then, as far as weekly sales, we've really hit a new line, which is about 500 off our peak, which was just over 600. But I'll take 500 sales a week. That's a very consistent number. I think it's a number that Orlando, with the way things are looking currently, even with the interest rates going up a little bit, I think we can still consistently stay in that 500 sales number.
Yep.
And then here we go, looking at our inventory, and we lost a little bit again, but I think a good portion of that was we had a big jump in temporarily off market because of the storm. Yeah. There may have been damage to the house, repairs that needed to be done. So we probably lost about 100, 150 homes due to the hurricane off the market. So we're sitting at an inventory level that's very consistent. It's not huge, but it's a good amount of homes that's giving people options. Mm-hmm. And we're seeing our days on market really starting to stay consistent in that 30 to 35 day range.
Yep.
So there's our consistency. We wanted some boring news. There's our boring news, Joe.
Yeah, so that's it. I will take boring, steady as she goes. We need that. There's too much. I want boring for the rest of the year if we can just get that.
Yeah, I could enjoy that. I really could enjoy just a straight kind of boring consistency. No more stress, no more reading the headlines going, oh my gosh, what happened today?
Yeah.
Yeah. But
the hard part is like you said, Britain coming back saying, or UN saying, oh, you guys are going to cause a global, those are type of things that are just going to create more turmoil and chaos. And that's the hard part is I kind of laughed in that because, and that those kind of announcements and stuff because it's everything we know, but when leaders start saying it, it has such a bigger impact.
Oh yeah.
Because markets react a lot differently.
Yes.
when that leader says it. We all know it, but
Yeah.
the moment they vocalize it, it creates the bigger issue.
Yeah.
And
The minute it hits the mainstream media, that's when everything gets a little crazy. So well, thank you for your time. I know you're under a schedule today.
Yep.
Appreciate it again, as always. Take care, everyone. Have a great day. Any questions, feel free to reach out to Joe and I. We're always here to help.
Sounds good.
Bye-bye.
Okay, guys.